I'm Charlotte McLeod with investingnews.com, and here today with me is Steve Penny, founder of silverchartist.com. Thank you so much for being here. Always great to have you.
You bet, Charlotte. Thank you so much for inviting me back. Look forward to a good conversation.
Me as well. It's been a while, so we've got quite a bit to catch up on. I was actually checking back to see when we last talked, and it was on January 20th. So I believe silver hadn't quite made it to $100 yet. We were still before all the triple-digit mania. But I wonder if we can think back to that time, and if you could start by going over how you played that price move in silver.
Sure, we did. And that was an interest that we spoke just before a key inflection point. I think we may be speaking again before a key inflection point, this time on the downside. But yeah, going back to last year, I make if-then statements, right? If this happens, then this becomes the path of least resistance. And I was saying, if we break above $54 silver, which happened the day after Thanksgiving, I believe on November 1st, then the measured move targets becomes 96. So 96 became my target. And then we, of course, overshot, went up to $121. So, I have a long-term investing bucket and some physical metal that I'm not touching for a very long time, if ever. Some of it's a generational insurance policy, but we also have a separate dedicated trading account. And in that trading account, we were taking aggressive profits from 100 up to 120 level. And, I don't want to sound like I was just cool, calm, and collected, and I knew it was going to peak, because I certainly didn't expect a 56% drop in price. We were fortunate that we were able to sell the majority of our speculative silver positions within a day or two of that peak. But in the moment, you have to trust your system. But my emotions were telling me, man, what if it just keeps running? What if it goes to 150? But I think that was a good exercise in playing how to play these volatile markets, because you can't be afraid to push the sell button, and you have to have a strategy, and you have to have a plan ahead of time, because trying to do it in the moment is nearly impossible. So having a plan ahead of time is key, and that's a key takeaway for us and our members.
I think that's great to go over as a starting point there. And so you mentioned we were around an inflection point at that time, and now perhaps near another inflection point. But did you say potentially to the downside?
Yes. And what I mean is, I think, that was near a major intermediate peak. Well, I think now we're nearing an intermediate bottom here. I'm calling the $48 to $54 area kind of the mother of all support zones, because obviously that's support, what previous resistance, now support, going back to 1980. So that area between 48 and 54 is really about the strongest support that silver has ever had. And it's David Morgan who says a silver bull market will either wear you out or scare you out. Well, I think this last 6 months has been the scare you out phase. A lot of people are panicking. They weren't prepared for a 50% drop. Unfortunately, I think what comes next is the wear you out phase. I think we get both. I'm not one who's expecting an immediate return to new all-time highs. I think it's going to take a lot longer than people think. However, the good news is that I call it our 1979 moment. Our 1979 moment still awaits, because in 1979, silver went up 8x in 12 short months. But you had to endure about 5 years of sideways grind from 1974 to 1979. So I think what we just had was our 1974 moment. If you overlay a chart from 1972 to 1974 and then go back to 2024 to 2026, it's almost identical, the move in silver, very, very similar. And what happened after that 1974 top was a 59-month consolidation period. I don't think it'll be quite that long this time, but I do think it'll be longer than many people think. And that's okay. You just have to adapt your strategy and I think set expectations properly, because it would take almost a double. Silver would have to more than double from the lows to get back to where we were back in January. So I think that's kind of an unrealistic expectation to just double from here in the next few months. Possible, but unlikely.
Well, I think this goes in a lot of good directions for us to unpack. I want to go back to where is the bottom for silver? I think a lot of people have that question, and it sounds like from what you're saying, there is still room for us to go a little bit lower than we are now. Anything further you'd add on that note?
Sure. Yeah. One of my sayings is I deal in probabilities, not predictions. So I look at what is the spectrum of plausible short-term outcomes here, like what's actually within the realm of possibility, and then assign probabilities to each. So I've been saying there's maybe about a 30% chance we dip down to that $48 to $54 level. I think the greatest possibility is probably, around 65% chance that the lows are in that $55 low was probably it if I had to bet. And then I think, roughly 5% chance that we just go up and clear $100 over the short term. That's the least likely outcome, but it's possible. And the key is to have a plan for, to position yourself so you're content regardless of what happens.
I think that makes a lot of sense. And maybe we can talk a little bit more about the path forward. So you mentioned you kind of see us maybe grinding sideways for some period of time. And of course, we can't know how long it will take. Is there a particular catalyst that you think could come up to break us out of this sideways move? Because I think, of course, people are going to wonder, how long do I have to wait this out?
Sure. Well, I think the next short-term catalyst, I think, here's some possibilities. Trying to predict the catalyst is always difficult, but right now, the new Fed chair, Kevin Warsh, is coming off extremely hawkish, and I think he needs to do that to establish credibility and to, not scare the bond market. So I think he's going to continue to do that for a bit, but I think as soon as there's a little bit of panic, he's going to start to talk a little bit more dovish. I think that's coming probably in the next, handful of quarters, and that could certainly be a catalyst as rate cut or rate hike expectations begin to moderate. I think that could be a tailwind at some point here in the next few quarters. Obviously, any kind of cessation with hostilities in Iran, that could be a bullish catalyst for the metals. But ultimately, the ultimate catalyst, I think, that sends silver to those big targets we're all talking about, 200 plus, $300 silver, 10,000 plus gold. I think it'll be the Fed's response to the next big panic, the next big deflationary impulse. That is the ultimate catalyst to send our focus sectors, silver, uranium, gold, platinum, hard assets, up towards those really high levels many of us have been waiting for. But I think there's got to be a panic first.
All right. So not necessarily what the Fed does in the immediate term here. I know we've got a Fed meeting coming up just next week, but something longer term that they're having to respond to.
Sure. And I think a better answer to put that a little more clearly, I think, when the Fed begins to moderate its hawkish tone and any cessation to the hostilities in Iran could be a catalyst for a move up. But I don't think that'll be the catalyst to take us to new highs. That could run us up to $70, $80, $90 silver, maybe to $5,000 gold or more. But I think it's going to be the Fed's response to the next panic that sends us to way, into new all-time high territory.
Got it. Thank you for explaining that. And you mentioned the Iran war. That's another major development that's happened since the last time we spoke. I think it's been pretty interesting to watch how silver as well as gold respond to that. And I think it has been a little bit maybe confusing for investors who would typically think, well, they should go up when we're in a crisis or war situation. But instead, we've kind of been seeing the opposite. So what are your thoughts on that? How would you explain it?
Yeah, I think it's a combination of factors. So whenever you are technically overbought, when you look at an RSI that's extreme overbought, conditions are ripe for a sell-off. And that was the condition we were in precious metals as that Iran war kicked off. We were extreme overbought. So we just needed a catalyst. Well, why would geopolitical conflict be a catalyst to the downside? Isn't gold supposed to be a beneficiary of that kind of environment? Well, over the long run, it is. But I think the market's perception, which may be beginning to change here, is that higher oil prices means the Fed has to be more hawkish, which means more rate hikes, which means bearish for gold and silver. I think that's kind of been the logic. But it's been interesting here the last few trading sessions, like even today as we're speaking. Well, today oil's down, but yesterday oil was up and gold was up. So it's possible that correlation is starting to break. Ultimately, it will, but I think that's how the market's been reacting right now.
And just a side note away from the precious metals as we're talking about the Iran war, it's put a huge spotlight on oil prices. And this past week, we had oil up above past $100 per barrel once again. Is that a sector that you're involved in? Have you been trading it during these last 6 months or so? How are you looking at it?
We were fortunate to get positioned in oil before all this started, before anyone was even talking about Iran war. Oil had double bottomed off of $55 support late in 2025. And we established some nice core positions. And the way we played this geopolitical conflict and oil price, the day after the Iran war kicked off, we did our weekend silver chartist report, and I titled it War Premium Strategy. And it seemed a little bit odd at the time, but it's worked out really well. And basically my playbook was to fade any rallies in silver, uranium, gold, and especially energy. And that really worked out well. We sold call options on the way up on our core positions, collected a few $1,000s of options income, and then maintained our positions. The shares weren't called away. And then, on the way down, we did the opposite. We sold put options. So I have if-then statements. To me, the oil market has so many cross currents that aren't necessarily like pure market driven. OPEC may, do supply cuts based on non-market decisions, right? Based on geopolitics. And it takes a lot to really have an information edge there. So rather than try and play that game of predicting the oil markets, I have if-then statements. If we pull down to the 60s, I scale in or sell puts. If we run up towards that 120 high that we saw back in March, well, then I sell call options. And that kind of takes the emotion out of it, and it allows you to profit when oil goes down and when it goes up. Because there's a case to be made for lower oil prices if and when this conflict ends, and there's a case to be made for much higher oil prices. So rather than try and predict it, I just have a strategy to profit regardless of whatever happens.
Makes a lot of sense. And when it comes to oil, are you looking for exposure to the commodity itself, or are you becoming involved with the oil companies, the stocks?
So I'll just tell you my three positions because it's nothing really too exciting. XLE, the energy sector ETF, the top three holdings are Exxon, Chevron, and I believe Williams Company, which is a natural gas pipeline play. And ConocoPhillips. So to me, with the energy space, I don't need to go far down the food chain. I think, being that these are highly stable companies with a long history of increasing their dividend, I'm comfortable just owning the big liquid names and trading around them. And they have very liquid options chains too, which makes it easy to generate additional income in addition to the dividend. So I don't get too fancy in the oil sector. Just have those three names and trade around them.
Yeah, I think that's similar to what I've heard from other people is you don't really need to get overly fancy when it comes to the oil sector. So thank you very much for sharing. As we're talking about strategy, I wonder if we can go back to silver. So you explained what you did at the beginning of the year when we had the big price run. What is your silver strategy looking like right now? I know you have the buckets. How is it looking?
Sure. Yeah. So in our long-term account, I'm just dollar cost averaging every month. I've been doing that for almost 20 years with physical metal. But in the trading accounts, this is an environment where obviously we're at I think a very good fundamental value proposition here in silver and silver mining stocks. But that doesn't mean they can't go 10 or 20% lower. So what I've been doing is just nibbling on weakness, buying small amounts because I've already got a core position. So my key with my speculative trading account is to always have enough cash where a 30% pullback doesn't bother me, but also have enough of an established position where 30, 40% run up doesn't leave me kicking myself with regret. So that's kind of the tightrope I'm trying to walk. And one thing I've been doing is selling puts. I know a lot of people aren't into options, but it's a really simple strategy and it's a great tool in your toolbox. And basically how it works is let's just say core mining, for example, that stock has gotten obliterated. Well, you can say, it's down to $15. It's already come down a lot, but maybe it's going to go down more. You can say, hey, you know what? I'll obligate myself to buy it at $13 or $12 in the next 45 days, but you got to pay me $300 or $400 for obligating myself to do so. And you can structure it so chances are you just keep the money and you can just do this over and over again every month. Or you get assigned the shares at an even better price than today. So it's a win-win situation. I think in this environment, unique things like that are ways to make continual profits, even as our focus sectors are going down or even sideways.
Well, the way you explain it makes it sound very simple. And I wonder, so we're talking about silver miners. I keep hearing that even though the price has gone lower, the margins are still so strong for these silver producers. So I wonder, is now the time for investors to focus more on silver producers, or is there a case to go down the food chain somewhat?
Well, I think it depends on everyone's risk tolerance and objectives. I know it's kind of a boring answer. I guess the older I'm getting, the more boring and conservative I get. I have no interest in any exploration or development companies. To me, everyone needs to know what your edge is in the market, right? If you're someone who can go read an NI 43-101 and read drill results and you feel like you've got an edge in the market, have at it. My edge is in timing the sector, not in individual stock selection. So I like the mid-tier producers with exploration upside. You get a lot of torque to the upside without all that dilution risk, or just simply more liquid names that you can use volatility to your advantage and trade around rather than going down the food chain. But I think that's a personal decision. There's not a right or wrong. I know there's a lot of smart people who can do that, and Everyone needs to know. The key is knowing what your edge is.
I think that makes a lot of sense. So we are in quarterly results season. We're starting to see companies come out with their results. When it comes to the silver companies, are there any specific companies you'll be watching for, or any particular red or green flags in the broader set of results that would tell us how the sector is doing?
No, I mean, I think everyone expects phenomenal results, and often when things are priced for perfection, there can still be downside. So trying to predict how the share price is going to react based on earnings reports, I would just be guessing. But I think the market right now, the general market is pricing in lower silver prices. So I think that creates kind of a contrarian opportunity where these things are getting fundamentally undervalued. Now, like, fundamentals are not a timing tool. Fundamentals tell me what to buy. Technicals tell me when to buy and when to sell. But from a fundamental basis, I mean, these companies are very cheap, and they could even get a little bit cheaper. But I think now is a great time to begin accumulating. And for those who are new to the sector too, your emotions are almost always great counter indicators, contrarian indicators. Because if you experience that big run up in January, probably the last thing you want to do is push the sell button. Even me, like I've been doing this for a long time, and I feel like I've conditioned myself to be able to execute my plan. But I remember pushing that sell button up at 118 on silver and thinking, man, like, the emotions were real. Like, am I making a huge mistake? I've been waiting all these years. My point is, it's kind of the opposite now. It's like, why am I going to buy now? These things are just going lower and lower. So I think you kind of got to let do the opposite of what your emotions perhaps suggest.
Yeah, that's really interesting. So you don't really need to look further than yourself in some cases to figure out what to do. That's really interesting. I want to make sure that we take a look over at gold as well. I wonder if you can talk about the support and resistance levels that you're seeing for the gold price right now. It's kind of seen a similar price reaction since silver from the beginning of the year.
Sure. I would say 2 key support levels and 2 key resistance levels that you can just kind of commit to memory in gold. So it's more of a support range we're in right now. But 3,900 is the bottom, 3,900 up to about 4,100. We're right in that support zone now, kind of bouncing around there. But that allows you to make some if-then statements, right? If 3,900 gives way, then the path of least resistance becomes a dip down towards the next major support level, which is between 3,500 and 3,600. To me, that's about the worst case for gold. Now, of course, it can go lower, but to me, like, within the spectrum of plausible outcomes, I think 35 to 3,600 is about my worst case outcome that I'm preparing for. So support levels, 3,900, 35 to 3,600. On the way up, 5,000 would be major resistance. And then, of course, the previous all-time high up at 5,600. So having those key levels, while they may not give you any predictive edge, they can allow traders to make if-then statements. If this happens, then I will do this. If this happens, then I will do that.
I think that's really helpful. And, to be clear, after we have this period of consolidation in gold and silver prices, you do expect them to go on to much, much higher levels after that time.
Absolutely, yes. The last thing I want to do is sound like I'm bearish or not excited about metals. I'm as bullish as you can possibly be. I just want to be honest with people that I think it could take longer. So it's easier to endure that if you're kind of mentally prepared for it. And, we take a Bayesian approach, and I will change that forecast on a dime. Like back in October of 2025, I did not expect it to break through $54 so soon. But once it did, I had to pinch my nose and buy right then and there because that was the trigger. So I'll be prepared to do the same thing. But my baseline expectation is for at least a few quarters of sideways grind for the wear you out phase, if you will.
Yeah, I do think that mental preparation is important. So thank you for taking us there. I want to bring up platinum as well. I know you have an interest in that metal as well. And again, similar to gold and silver, the big move at the beginning of the year, now we're in this pullback. But it does seem like it's settled above that range that it spent years and years in. So I wonder what you see coming for platinum. Are you as bullish as you are on gold and silver?
I am, yes. Yeah, to me, platinum has the most upside potential, even more than silver, although it carries a little bit more risk. It's a little bit more speculative. To me, I like about 20% of my physical metal in platinum. And right now, platinum is the most undervalued in the precious metals complex, if you want to consider platinum a precious metal. So looking at platinum to gold ratios, platinum to silver ratios, platinum is near historic, all-time record undervaluation. I mean, there was a spike late last year where it was a little bit cheaper relative to gold and silver, but historically, platinum is, you can make a very solid case, it's the most undervalued metal. Of course, it's more volatile, a little bit more risky, but if you've got that risk tolerance, I think platinum can make a lot of sense right now. And for me, my favorite way to play it is just to have physical metal, because it's really hard to find quality platinum, pure play platinum mining stocks. There's a couple of decent ones out there, but I prefer just the metal.
Well, I think it's always nice when we can keep it a little bit simple. Yeah. Of course, I wanted to have us take a look at uranium as well. So I think that investors are finding it a little bit frustrating right now because we hear so much about the strong fundamentals for the sector, the positive long-term outlook, but then the stocks are not really moving in line with that. So what do you think is going on there?
Well, I think the short-term narrative, which works in both directions. So back in January, uranium had a big run up. We got just over $100 in uranium in January before pulling back. Now, it's around 85, so that's not too big of a pullback in the spot price, but the mining stocks have, they're down, some of them around half. So I think they're very, for better or worse, tied to the AI data center narrative right now, where to me, the AI data center narrative is an upside kicker. It's not a thesis breaker. It's just a pure upside kicker. It's not required. There's structural supply deficits coming for uranium, regardless of AI data center buildouts or not. So, the AI data center, AI stocks are taking a hit recently, and I think uranium's kind of gotten caught up in that. But as a well-informed contrarian investor, you can use that volatility to your advantage. And buy when others are fearful. I look at a stock like Uranium Energy Corp, for example. It was $21 in January. Now it's in the 9s. It's less than half. And nothing really has fundamentally changed with that company. I think there's a lot of fantastic deals right now in uranium. And before I get too long-winded, I'll just mention one thing. Uranium is actually my favorite sector to accumulate right now. Because when I look at a ratio chart of uranium versus gold, uranium is just beginning to outperform gold on a ratio basis, and it had gotten historically cheap. I believe it was 15 consecutive months where gold outperformed uranium. So priced in gold, uranium is actually really, really cheap. And uranium got to $148 back in 2007. So gold has made a new all-time high. Silver has made a new all-time high. Uranium is still just over half of its previous all-time high. So I think it's got a lot of upside in uranium. It's volatile. It's a wild sector. But for those who can stomach that volatility, I think they'll be handsomely rewarded in the fullness of time.
So going back to that AI data center connection with uranium that we're seeing right now, is that a sign that more people from outside, maybe the mining sector, are looking at uranium stocks right now?
Let's see, people outside of the mining sector looking at uranium. Well, yes, I think so. I think that's what led. I was just processing your question. Yeah, I think that's what led to the big run up into January. Is a lot of generalist investors looking at AI adjacent plays. Okay, we know about the NVIDIAs and all those. Well, what's adjacent to that? And I think that uranium caught a lot of generalist investor attention, had the big run up, and some of those nuclear stocks like Oklo, for example, just went up like 5, 6, I can't even remember, it might have been 10x, up near $200 a share. Well, now Oklo is down to $40 a share. So yeah, the uranium space did get caught up with a lot of generalist investors, but those are also the people, the Johnny-come-latelys, who are weak-handed momentum chasers. The second their thesis stops working, they're out of here. So now those people are gone, which is healthy. So now we're going to form a new base as kind of people with strong hands. The people with a deep fundamental conviction in the sector are the ones accumulating now, and that's what causes a solid floor of support to form, which provides a base for the next rally higher.
Yeah, that is very interesting. So I was going to ask what the catalyst is to get those stocks moving. So it sounds like maybe the sector just needs to normalize a little bit better and get back to those fundamentals.
Yeah, and I'm not an expert in the weeds on uranium. I'm more of a chartist, but yeah. The long-term contracting price right now is higher than the spot price. And when that happens, typically the spot price plays catch up. And what I think could be a potential catalyst is for more long-term contracting deals at higher prices, north of $100. That's what these companies are actually going to realize as their sale price of their material. So I think that's coming. I think it's almost inevitable, and I think it's probably going to come. I would be very surprised if the uranium sector as a whole were trading we're not trading meaningfully higher by the end of the year. I'd be very surprised at that.
Just one more question on uranium, and we may have talked about this before. I've definitely spoken about it to other people. It sounds like it's a sector. We have a lot of people, I think, in our audience who like to buy and hold, but it's starting to sound more to me like a sector with all these ups and downs that people might want to consider trading in and out of more frequently. So I wonder what your thoughts are on that angle.
Well, there's pros and cons, because obviously everything has pros and cons, but we've done that over the last handful of years. But the way I do it is I have separate accounts. So I literally create separate brokerage accounts. So I've got one, and you can name your brokerage account. So I call one long term. So in that, it's my long term position. So whenever I'm logged in there, I know I'm not just selling those because daily RSI is overbought. And then I've got a separate dedicated account I call my volatility advantage account. And that's where I've given myself permission when we get overheated short term, trim profits. And then when we get oversold against support, I scale back in. The risk of just doing, someone might say, well, why not just trade the whole thing? Well, one of these days, I think we're going to get overbought and it just keeps going. That's what happened in silver when it went up to 120. So in order to not get left behind, that's why I've got the long-term account. So I think strategy is greater than predictions in that regard, but there's a place for both.
Yeah. Again, I really like the bucket strategy, and you can see how it comes into play there. I think we're getting toward the end, but I do want to bring up the general stock market. So when we were talking toward the end of the year, you mentioned that it was really looking pretty ripe for an unexpected pullback, but you weren't seeing the technical signs for that. So I wonder how it's looking now. Are you seeing any technical signs that we could have that stock market pullback?
No, I mean, I think the conditions remain ripe for a pullback, in a big general equity pullback. But looking at the charts, I'm not seeing any signs of that. Price is still above a rising 50 and 200-day moving average in most cases. The NASDAQ may have lost the 50-day, but that's not too big of a deal. I'm not seeing any warning signs yet. I wouldn't be surprised if we had, putting on my speculator hat a little bit, and of course I could be wrong, but kind of what I would like to see, and what I think is very likely, is before we get the big stock market correction, we could see kind of a big blow off top, even more vertical than we've seen. And I hope we get that, because if you get extreme overbought in multiple timeframes, that's an opportunity to speculate and capitalize on any kind of big decline on the other side of that. So that's my baseline expectation. We can continue to trend higher. I think this thing culminates in a blow off top before the big panic-driven sell-off, where the Fed comes in with debt monetization, currency creation on steroids, and that's when we get the big inflation and the big run-up in our precious metals.
Yes. So once again, we can see how everything is connecting there for your thesis. I will let you go unless you had any final thoughts that you would want to share with investors now.
No, I think we covered all the sectors, and always enjoy talking with you and your audience. So thank you so much for having me.
Well, of course, it's always great to talk to you as well, and we'll make sure to have you back again soon. This was great. For now, once again, I'm Charlotte McLeod with investingnews.com, and this is Steve Penny with silverchartist.com. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.